September 15th, 2008. It's a Monday morning.
Yeah.
And, depending on where you were in the world, the sun was just coming up or the day was already halfway done. You might have been grabbing a coffee, getting the kids ready for school, or maybe you were already at your desk. But when you turned on the news that morning, everything had changed.
It was a fundamental shift, a watershed moment, really. Lehman Brothers had filed for bankruptcy.
And we have to be clear here, this wasn't some, fly-by-night startup or regional bank that took a few bad bets.
No. This was an institution. I mean, this is a bank that had survived the U.S. Civil War.
The Civil War.
It survived the Great Depression. It survived 2 world wars. And then, poof.
And the scale of it was just, it was massive.
It was the 4th largest investment bank in the entire United States. You had Goldman, Morgan Stanley, Merrill Lynch, and then Lehman. And just like that, in the blink of an eye, it was gone. Insolvent.
I think for a lot of us, even if we weren't, following the financial pages every single day, that was the moment the ground actually shook.
It was. Before that Monday, you heard rumblings, right? Maybe you saw a headline about housing prices softening a bit in Florida or something about subprime on the back page of the newspaper. But Lehman, that was the earthquake.
It really was the climax of a tragedy that had been written, really, over the previous decade. But you're right, the psychological impact was just immediate.
How do you even measure that?
Well, there's a metric we look at called the TED spread. It sounds super technical, but it's not. It's basically a fear gauge.
A fear gauge. I like that.
It measures the difference between what the U.S. government pays to borrow money and what banks charge to lend to each other.
So, okay, if the banks all trust each other, the spread is low. They're all on the same team.
Exactly. But on that morning, the TED spread it spiked to record highs. Trust had completely evaporated from the system.
It wasn't just that Lehman was gone.
No. It was that no bank knew if the bank across the street was next. So what did? They just stopped lending to anyone. The plumbing of the entire global financial system just clogged solid. And that is exactly what we are here to do today. We are going to go deeper than just a timeline or a list of failed banks. We want to unpack the anatomy of this disaster.
Right.
How do you go from one guy in, Ohio defaulting on a $200,000 mortgage to the entire global economy almost turning off?
It is a fascinating and, frankly, a terrifying journey. It involves everything from the very bottom of the economic ladder. We're talking predatory loans given to people who had absolutely no hope of ever paying them back, all the way to the absolute peak of intellectual hubris, where, mathematicians with PhDs convinced themselves they had conquered risk with these beautiful, elegant formulas.
We're going to be looking at the so-called villains, or maybe it's better to call them the enablers.
The enablers is a good word for it.
The shadow banking system, the rating agencies, the regulators who were, completely asleep at the wheel. And for this deep dive, we are going to be relying on a massive stack of sources.
We have the Financial Crisis Inquiry Commission report, which is it's the official autopsy, really.
We've got economic data from the Federal Reserve, and we've got contemporary accounts of the panic as it was happening.
And you're right, we have to start with the setup. Because a fire this big doesn't just start on its own. You need dry wood, you need a whole lot of gasoline, and then you need a spark.
So let's talk about the fuel. Before the panic, before the bailouts, even before the housing bubble really got inflated, how did the world get so awash in cash that we started doing really, really stupid things with it?
You have to rewind the clock. Go back to the early 2000s.
Yeah.
And you have to think about where we were as a country, psychologically.
The dot-com bubble had just burst.
Right, in 2000. That wiped out trillions in paper wealth. Trillions. Then, of course, the absolute tragedy of September 11th, 2001. The U.S. economy was reeling. It was vulnerable.
I remember that time so clearly. There was this genuine, palpable fear that the economy would just grind to a halt.
Precisely. So the Federal Reserve, which was led by Alan Greenspan at the time, decided to do what a central bank does in that situation. They decided to flood the engine with gas.
They lowered interest rates. Dramatically.
I mean, we went from interest rates of about 6.5% in the year 2000 all the way down to just 1% by 2003.
1%. That's effectively free money.
It's historically unbelievably low. And the idea was simple, right? To incentivize borrowing. If money is cheap, businesses will borrow to expand, and people will borrow to buy houses and cars.
And it worked.
It did. It stimulated the economy. But there was another massive factor at play here. Something that Ben Bernanke, who would eventually succeed Greenspan, he called it the global savings glut.
Okay, let's stop and unpack that for a second. Global savings glut. It sounds like we just had too much money in the world's piggy bank. Why is having too much savings a bad thing?
It's not bad in isolation, but it creates these massive distortions. You have to look at the geopolitics of the moment. And the late 90s, the Asian financial crisis absolutely devastated economies like Thailand, South Korea, Indonesia. Those countries learned a very, very hard lesson. Never, ever rely on foreign lenders who can pull their money out on a whim. So what did they start doing? They started saving aggressively. They ran huge trade surpluses with the U.S. and stockpiled cash.
So you have these enormous pools of capital just sitting in Asian central banks, and at the same time, oil prices are rising, so the Middle East has tons of cash too.
Right. And all this capital.
Yeah.
It needs a home. It needs to be invested somewhere. But here's the key. These countries were terrified of risk.
After what happened in the 90s.
Exactly. They didn't want to buy tech stocks or risky ventures. They wanted safety. They wanted U.S. dollars. And specifically, they wanted what are called safe assets, things like U.S. Treasury bonds.
So you literally have a wall of money coming from overseas, and it's all aimed at the U.S. financial system.
A tsunami of money is a better word for it.
Yeah.
Trillions of dollars flowing into the U.S. debt markets. And this, in turn, drove interest rates down even further. But here's the catch.
What's the catch?
There weren't enough U.S. Treasury bonds to go around. The demand for safe assets completely outstripped the supply.
And this is where the psychology gets so interesting, right? You have these huge investors. We're talking pension funds, foreign governments, insurance companies. And they need two things that usually don't go together. They need absolute safety, so a AAA rating, but they also desperately need a return on their investment. And with interest rates at 1%, you just can't make any money buying government bonds.
You've hit the nail on the head. They were absolutely starving for yield.
Starving for yield.
Imagine you manage a pension fund for, say, a bunch of teachers. You have to pay them their retirement in 10 years. You need to make, let's say, 7 or 8% a year to meet those obligations.
Right.
If safe government bonds are only paying 1 or 2%, you are in huge trouble. You are desperate for anything that pays more but is still quote-unquote safe.
And Wall Street, being the helpful, innovative service provider that it is, basically said, don't you worry, we can fix that for you.
Wall Street had a light bulb moment. They realized they could manufacture a product that looked and felt like a safe bond, but paid a much higher interest rate. And the raw material for that product was the American housing market.
Which brings us to the housing mania. I think everyone, whether they owned a home or not, remembers this era. It just felt like the basic laws of economic gravity had been suspended.
Oh, the numbers are just staggering. Between 1998 and 2006, the price of the typical American house increased by 124%.
124%. That's more than double in less than a decade.
And it wasn't supported by fundamentals. It wasn't supported by income growth. Historically, in the U.S., a house costs about 2.9 to 3.1 times the median annual income. It was this incredibly stable ratio for decades.
And where did it go?
By 2006, that ratio hit 4.6. Houses were becoming fundamentally unaffordable for the people who were supposed to be living in them.
But people kept buying. The mania just took over.
Because of the psychology of the bubble. If you believe, truly believe, that the price of your house will go up 10% next year, it makes all the sense in the world to buy now, even if you have to stretch your budget to the breaking point.
And it wasn't just buying. Homeowners started treating their houses like personal ATM machines.
This is the home equity line of credit, or HELOC craze.
Right.
Exactly. You buy a house for $200,000. 2 years later, the bank sends you a letter saying, congratulations, it's now worth $300,000. You feel $100,000 richer.
So you refinance.
You refinance, you pull out that equity, and you buy a boat or a second car, or you go on a big vacation.
Yeah. Between
Between 2001 and 2005, American homeowners extracted nearly $5 trillion in home equity.
$5 trillion. That's an unbelievable amount of consumption that was just fueled by paper gains. It wasn't real.
It propped up the entire U.S. economy for years.
Hmm.
But it was all built on one single, incredibly fragile assumption.
That prices would never fall.
That they would never fall.
Okay, so we have the fuel, all this cheap money, this global demand for safe assets. We have the raw material, the ever-rising price of American homes. Now we need to talk about the machine, the meat grinder that turned all of this into a global disaster.
This is where we get into the plumbing of the crisis. And, it starts with the loans themselves. In a normal, functioning world, banks lend to what we call prime borrowers.
Good credit, steady job, 20% down payment, the whole thing.
The whole 9 yards. But eventually, you run out of those people.
Right.
But Wall Street's appetite for mortgages was insatiable. They just kept demanding more and more raw material to package up for those global investors we talked about. So when the prime borrowers ran out, they didn't stop. They just lowered the standards.
And this is where subprime comes in.
Enter subprime. It generally refers to borrowers with FICO scores below 660. But as the bubble inflated, they went lower and lower and lower, eventually lending to people with scores below 620.
But it wasn't just the credit score, was it? It was the documentation, or the lack of it.
That was the real scandal. We went from full documentation loans to low doc, and then finally to no doc loans.
I've heard the stories. This is the era of the nanananja loan.
That's right. No income, no job, no assets.
Just walk me through this because it sounds insane. I walk into a bank, I have no job, I have no income to show you, I have no assets, and you're going to give me $500,000 for a house. How does a loan officer even justify that on paper?
Well, in the old days, it's a wonderful life banking model. The bank wouldn't do it. It's that simple. Because the bank kept the loan on its books. If you didn't pay, the bank lost money.
But the model had changed.
The model had completely changed to originate to distribute. The mortgage broker and the lender, they originate the loan, they take a fat commission fee right up front, and then they instantly sell that loan to a Wall Street bank.
So they have zero skin in the game.
None. Zero. In fact, the worse the loan, often the higher the commission because these were higher interest, riskier loans, and this led to the rise of what were called liar loans.
Liar loans.
Where lenders would essentially tell borrowers, look, just write down that you make $100,000 a year. We're not going to check.
There's that famous, almost apocryphal story of the strawberry picker in California.
I know the one you mean.
Making something like $14,000 a year and was given a loan for a $720,000 house.
And it happened everywhere. Countrywide Financial, run by Angelo Mozillo, was the absolute poster child for this. Their internal culture was just volume, volume, volume. Their motto was fundum. If the borrower had a pulse, they got a loan.
Okay, but this is the part I always get stuck on. I get why the local mortgage broker doesn't care. He gets his fee and moves on. I get why Countrywide sells it to Wall Street, but why does Wall Street buy it? Why does Lehman Brothers or Bear Stearns want a big box full of these obviously toxic loans?
Because of the alchemy of securitization. This is the sausage-making process you hear about. Wall Street takes thousands of these individual loans. Some are okay, some are terrible, and they put them all into a trust. They bundle them together into what's called a mortgage-backed security, or MBS.
But a bundle of bad loans is still, well, it's still a bundle of bad loans, isn't it?
But then they slice them up. This is the critical concept. The CDO, or collateralized debt obligation. The best way to think about it is to imagine a waterfall.
Okay, I'm with you. A waterfall.
The money from all those thousands of homeowners paying their mortgages every month. That's the water flowing down from the top. And the investors are all standing at different levels of this waterfall, holding buckets. The investors at the very, very top, they're in what's called the senior tranche. They get to fill their buckets first.
So if a few people default and the flow of water slows down a little bit, the guys at the top, they're fine. They still get all their water.
Exactly. They are protected. You would need a massive, catastrophic amount of defaults for the water to stop reaching the top of that waterfall. And because they are so safe, the credit rating agencies, we're talking S&P, Moody's, Fitch, they come in and they stamp that top tranche with a AAA rating.
The highest rating there is, the same rating as the U.S. government.
The very same. Then you have the middle tranches, the mezzanine tranches, and finally at the very bottom, you have the equity tranche, or what Wall Street insiders call the toxic waste.
The toxic waste.
These guys only get paid if everyone, down to the last person, pays their mortgage on time. If there are any defaults at all, they get hit first. But in exchange for taking on all that risk, they get a huge interest rate.
So Wall Street essentially convinced the entire world that they had taken a pile of risky subprime loans, and through the magic of financial engineering, slicing and dicing, they had created brand new, risk-free assets.
Yes. And the global investors we talked about earlier, they couldn't buy them fast enough. The volume was just insane. CDO issuance peaked at over $180 billion in just the first quarter of 2007 alone.
We have to talk about the math behind this for a minute, because there was a specific Nobel Prize-winning formula that everyone was using to justify this whole thing, the Gaussian copula.
Right. This gets a little nerdy, but it's Absolutely crucial to understanding the intellectual failure here. The Gaussian copula was a formula that was adopted by Wall Street to measure the correlation between defaults.
So basically, what are the odds that if person A defaults on their mortgage, their neighbor, person B, will also default?
Exactly. And what did the model assume? It assumed very low correlation.
What does that mean in simple terms?
Well, think of it like this. If it starts raining in Seattle, does that mean it's also raining in Miami?
No, of course not. They're completely independent events.
Right. So if you're an insurance company and you insure houses against rain damage in 50 different states, you're pretty safe. They're not all going to flood at once. That is exactly how they viewed mortgages. They thought real estate is local. If the housing market in Florida crashes, Texas might be booming. If Arizona goes down, Ohio will be fine.
But what if it's not rain? What if it's a giant asteroid that's heading for Earth?
Exactly. If an asteroid hits, it burns everywhere at the same time. The correlation goes to 1. The model, the Gaussian copula, it did not account for a national decline in housing prices. It assumed that was impossible because it hadn't happened since the Great Depression.
So when prices started falling everywhere at once.
The math just broke. The models failed spectacularly. The AAA tranches weren't safe at all. They were just the last to drown.
And it gets even worse, because they didn't just stop at betting on the actual loans. They started making side bets.
This is when we enter the shadow world of derivatives and credit default swaps, or CDS. A CDS is basically an insurance policy. You pay a premium every month, and if a bond or a CDO defaults, the insurer pays you the full value.
Okay, that sounds like a prudent thing to do if I actually own the bond. I'm insuring my investment.
But here's the crazy part. You didn't have to own the bond to buy the insurance on it.
Wait, hold on. Let me get this straight. If I want to buy fire insurance on my house, I have to actually own the house. I can't buy insurance on your house and then, hope it burns down so I can collect. That's illegal.
In the normal insurance world, yes, it's illegal. It's called not having an insurable interest. In the completely unregulated derivatives world, it was perfectly legal and incredibly common. It's like standing at a racetrack. You aren't riding the horse, you don't own the horse, but you can bet millions of dollars that the horse will break its leg.
So this is what created the synthetic CDO.
That's right. They created these new, purely synthetic bundles of bets. This meant that while there might be, say, only $10 million of actual bad loans in existence, there could be $100 million or $1 billion of bets riding on whether those loans failed or not. It magnified the potential losses exponentially.
And this is where the insurance giant AIG steps into the picture.
AIG was, at the time, the biggest insurance company in the world. They had a small division based in London called AIG Financial Products that sold trillions of dollars worth of these swaps. They were essentially selling fire insurance on houses that were already smoldering. But they treated the premiums they collected as pure, risk-free profit.
They didn't put aside enough capital reserves to actually pay out if the fire started.
Not even close. It was just breathtaking recklessness.
Okay, we have one more crucial piece of this machine to assemble before we can watch the whole thing blow up. The shadow banking system.
This is a term that sounds like something out of a spy novel, but it is probably the most important structural flaw in the entire system.
So what exactly is a shadow bank?
It's any financial institution that acts like a bank, so it's lending and borrowing. But it isn't a traditional commercial bank with deposits. We are talking about the big investment banks like Lehman Brothers and Bear Stearns, hedge funds, and these strange entities called SIVs, or structured investment vehicles.
What's the fundamental difference between them and my local Bank of America branch?
2 things: regulation and insurance. Your deposit at Bank of America is insured by the FDIC up to a certain limit. If the bank fails, the government guarantees you'll get your money back.
Lehman Brothers had no such guarantee.
None, and they operated on a scale that is just hard to comprehend. By 2007, the shadow banking system was actually larger than the traditional banking system. Investment banks alone held around $4 trillion in assets. But here's the fatal flaw, the Achilles heel.
Which is?
The asset-liability mismatch.
Okay, break that down for us.
A traditional bank takes your deposit, which is a short-term liability. You can ask for it back anytime. And it lends it out for 30 years in a mortgage, a long-term asset. That's always a bit risky. But shadow banks were doing something far, far riskier. They were funding their massive operations using something called the repo market.
The repo market. This is one of those terms that Wall Street people throw around that makes normal people's eyes glaze over. But you're saying it's critical, so how does it work?
Think of it like a pawn shop for billionaires.
Okay, I like that.
Lehman Brothers holds a mortgage-backed security that's worth, say, $100. but they need cash today to pay their staff, make trades. So they go to a lender, maybe a big money market fund, and say, here is this $100 bond. Lend me $98 in cash just for tonight. I promise I'll buy the bond back from you tomorrow morning for $98 plus a tiny bit of interest.
So they are borrowing massive amounts of money for literally 24 hours.
Yes, they are rolling this debt over every single day. Now, imagine Lehman is doing this with billions and billions of dollars. They are borrowing billions every night to fund assets, these mortgages. That won't pay off for 30 years.
It only works as long as the lender agrees to renew the loan the next morning.
Exactly. But what happens if that lender wakes up, reads the news that mortgages are going bad across the country, and says, you know what, I don't really trust that bond you're giving me as collateral anymore. I want my cash back. And I'm not lending to you again today.
The bank has no cash. They're insolvent instantly.
That is what we call a run on the repo market. It's an electronic, invisible bank run. There are no lines of people outside a teller window, just funding that disappears at the speed of light.
And these banks were so leveraged.
Insanely leveraged, borrowing $30, sometimes $40 for every $1 of their own money they had. A tiny, tiny drop in the value of their assets was enough to wipe them out completely.
So the tank is full of gas. The fumes are literally everywhere. Let's talk about the tremors, because this disaster didn't happen all at once on September 15.
No, not at all. The cracks started to appear well into 2007. We saw housing prices peak in mid-2006 and then start to roll over. Defaults started to tick up. And you had these classic warning signs, like the inverted yield curve in August of 2006, which is a textbook recession signal.
And some people saw it coming, right?
Right.
Michael Burry, the guy from the movie The Big Short.
He did. He was betting against the subprime market as early as 2005. But, the mainstream completely ignored him. They thought he was a crank.
So what was the first real crack in the dam?
In early 2007, a huge subprime lender called New Century Financial went bankrupt. That was a big deal. Then, in June of 2007, two hedge funds run by Bear Stearns completely collapsed.
But the real oh crap moment for the global system was in August 2007 with that French bank, BNP Paribas, right?
Yes, that was the moment the music stopped. BNP Paribas is a massive global bank. They froze 3 of their investment funds. And they sent out this letter to their investors saying essentially, we cannot calculate the fair value of the assets in these funds because there is a complete evaporation of liquidity.
Which is banker speak for. We have no idea what this junk is worth, and absolutely no one on earth will buy it from us at any price.
That's a perfect translation. And that was the moment the credit markets seized up for the first time. Banks stopped trusting each other's collateral. The fear was spreading.
Let's fast forward a bit to March 2008. The first of the giants starts to fall. Bear Stearns.
Bear Stearns was the smallest of the big 5 investment banks, but it was by far the most exposed to the mortgage market. And just as we described, they face a classic run on their repo funding. They were just bleeding cash every single day.
And the government had to step in.
The Federal Reserve and the Treasury, led by Hank Paulson, engineered a forced marriage. They strong-armed J.P. Morgan Chase into buying Bear Stearns over a single weekend.
But the price was the real shocker.
It was unbelievable. A year earlier, Bear Stearns stock was trading at $170 a share. The initial deal that was announced was for $2 a share.
$2! You couldn't buy a cup of coffee in New York City for the price of a share of a Wall Street titan.
They eventually had to bump it up to $10 a share to keep the shareholders from suing everyone into oblivion. But the message was sent. You can be a giant one day and be completely wiped out the next.
But the Fed did something else, didn't they? They sweetened the deal for J.P. Morgan.
They did. And this set a very dangerous precedent. The Fed agreed to take $30 billion of Bear's most toxic assets onto its own books, onto the taxpayer's balance sheet, to make the deal happen.
And the market saw this and thought.
The market thought, oh, okay, Uncle Santa's here. He won't let the big boys fail. It created this massive sense of moral hazard.
The Fed put.
Exactly. Everyone assumed there was a Fed put, that the government would always be there to bail them out no matter how reckless they were.
But before we get to the main event in September, I want to zoom in on a story from that summer that I think just perfectly captures the human panic of this whole era. IndyMac Bank.
IndyMac is such a crucial case study. It was a big savings and loan based in Pasadena, California, and they were aggressive. They specialized in what were called Alt-A loans.
What's an Alt-A loan?
Sort of the gray area between prime and subprime. Low documentation, but maybe for a borrower with a decent credit score. And it turned out they had been fabricating their capital strength for years.
And Senator Chuck Schumer got wind of this.
He did. He released a public letter in late June of 2008 questioning whether IndyMac was actually solvent. And when the public saw that letter, it triggered an old-fashioned 1930s-style bank run.
You can picture it.
Oh, I want you to picture it. It's July in Southern California. It's hot. And there are hundreds, thousands of people lining up around the block, sweating, holding their passbooks and their bank statements, just desperate to get their life savings out of that bank.
It's a scene from Mary Poppins or, like you said, the Great Depression in 2008.
In 2008. In about 10 days, depositors pulled $1.5 billion out. The bank completely collapsed. The FDIC seized it on July 11th.
And here is the really terrifying part for the average person. People lost money.
That's right. The FDIC insurance limit at the time was $100,000. If you had more than that in your account, you took a haircut. Uninsured depositors lost about $270 million.
And that sent a shockwave through the public consciousness. It meant safe wasn't safe anymore.
Exactly. So the tension is just building and building all summer. And then the two pillars of the entire U.S. mortgage market, Fannie Mae and Freddie Mac, they start to shake.
And these aren't just banks. These are quasi-governmental.
They owned or guaranteed something like $5 trillion in mortgages, half the entire market. By September, they were effectively insolvent. So on September 7th, the government took them over, placed them into conservatorship. It was the biggest nationalization in American history.
You would think that would calm the markets down. Okay, the government has stepped in and secured the mortgage market.
You would think. But the market is like a predator. It looks for the next wounded animal in the herd. And that animal, without a doubt, was Lehman Brothers.
So take us into that room, the weekend of September 13th and 14th, the now infamous Lehman weekend.
The meetings took place at the Federal Reserve Bank of New York. It's this imposing fortress-like building in downtown Manhattan. You had the three most powerful financial figures in the country in a room. Hank Paulson, the Treasury Secretary, Ben Bernanke, the Fed Chair, and Tim Geithner, the president of the NY Fed.
And they summoned all the Wall Street CEOs.
That's right. They basically locked them in a room and said, you guys are going to figure this out. The smell of fear in that room must have been potent.
And the plan was to find a buyer for Lehman, just like they did with Bear Stearns. They were trying to get Barclays or Bank of America to step up.
They were, but Hank Paulson, who was getting hammered by the public and by Congress about bailouts, he drew a line in the sand. He said there would be no government money this time, no taxpayer funds. He wanted the market to solve its own problem.
He was playing a very, very dangerous game of chicken.
And he lost. Barclays wanted to buy Lehman, but British regulators wouldn't approve of the deal without a U.S. government guarantee. Paulson said no, so Barclays walked away. Bank of America, meanwhile, took a look at Lehman's toxic books, saw the absolute sludge in their balance sheet, and said, no thanks.
And instead, they bought Merrill Lynch.
That's right. Merrill was also teetering on the brink, so in a stunning move, Bank of America bought Merrill Lynch that same weekend, saving it from collapse.
Which left Lehman all alone.
All alone at the dance. So on Monday morning, September 15th, at about 1 in the morning, Lehman Brothers filed for Chapter 11 bankruptcy protection.
And the world broke.
It did. The Dow plunged over 500 points. But the real disaster wasn't the stock market. It was the interconnectedness. We talked about AIG earlier and all those credit default swaps they had written.
Mm-hmm.
When Lehman failed, it was a credit event. It triggered a clause in all those CDS contracts AIG had sold.
So the people who bought the insurance from AIG, they all came knocking at once.
They came knocking. They said, Lehman just died. The world is a much more dangerous place. We don't trust you anymore, AIG. You need to post collateral. You need to give us cash right now to prove you can pay us if we need it.
And AIG needed billions of dollars instantly, and they didn't have it.
Not even close.
So if AIG fails, what happens next?
If AIG fails, the entire global financial system implodes. The banks that bought the insurance from them, we're talking Goldman Sachs, Deutsche Bank, Société Générale in France, they all take catastrophic losses. Their capital's wiped out. They fail. Then the companies that rely on those banks for funding fail. It's a chain of dominoes, but the dominoes are the size of skyscrapers.
So on Tuesday, September 16th, just one single day after letting Lehman die on principle, the government does a complete 180.
A complete 180. They bailed out AIG with an $85 billion loan from the Federal Reserve.
$85 billion.
Yeah.
It's a number that's hard to wrap your head around.
It was necessary to stop the immediate bleeding, but the inconsistency, saving Bear Stearns, killing Lehman, then saving AIG. It absolutely terrified the markets. They didn't know what the rules of the game were anymore.
And amidst all this chaos, we have what might be the single scariest moment for the real economy. The moment a money market fund broke the buck.
This was the Reserve Primary Fund. It was one of the oldest and largest money market funds in the country. And these funds are supposed to be the most boring, safest investment on the planet. You put $1 in, you get $1 back, plus a tiny bit of interest.
Yeah.
It's where big corporations park their cash to make payroll.
But they held Lehman debt.
They held a lot of Lehman commercial paper. And when Lehman went to zero, the fund's assets dropped in value. The share price, which is always supposed to be $1, fell to 97 cents. It broke the buck.
Why does 3 cents matter so much?
Because it caused a global panic. If a money market fund isn't safe, then nothing is safe. Investors pulled $144 billion out of money market funds in just a couple of days. It was a massive silent run on the system.
And here's the connection to you, the listener, and your job. Those money market funds are the primary buyers of something called commercial paper.
Exactly. A company like General Electric or Ford or Toyota, they issue this short-term debt, this commercial paper, to pay for their daily operations, to make payroll, to buy steel for their factories.
And when the money market funds emptied out?
They stopped buying commercial paper. The market completely froze solid.
So suddenly, a company like General Electric can't borrow the money it needs to operate day to day.
We were days, maybe hours, away from major U.S. corporations not being able to write paychecks to their employees. And that is the moment when Bernanke and Paulson went to Congress, looked them in the eye, and basically said the financial world was looking into the abyss.
They proposed TARP, the Troubled Asset Relief Program. $700 billion to buy up the bad assets from the banks and stabilize the system.
And in a moment of just stunning political theater, on September 29th, the House of Representatives voted no.
They voted it down. I remember watching CS-PEN that day. The ticker on the screen for the vote and the stock market ticker right next to it, just going down and down and down.
The Dow Jones Industrial Average dropped 777 points in a single day. At the time, it was the largest point drop in history. $1.2 trillion in market wealth just evaporated. The government was told the economy will collapse without this. And Congress said, we don't care, our voters back home hate bailouts.
It took that massive market crash to force their hand. They held another vote on October 3rd, and this time it passed.
But the damage was done. The fear was entrenched. The recession, what we now call the Great Recession, was fully underway.
So let's look at the fallout from all this.
Okay.
Because while the banks and the big institutions got the lifeboats, the passengers on the ship, the American people, they were left in the freezing water.
The human cost was just devastating. $11 trillion in household wealth was lost in the United States.
$11 trillion. That's retirement accounts, 401ks, college funds, and of course, home equity.
All gone. Unemployment doubled, eventually hitting 10%, but even that number hides the real pain. We lost 8.7 million jobs. Long-term unemployment skyrocketed. You had men in their 50s who lost good manufacturing jobs and never worked at the same level again.
And the foreclosures, the images of people's belongings out on the curb.
It was heartbreaking. Neighborhoods were just hollowed out. In places that were at the center of the bubble, like Las Vegas, Phoenix, parts of Florida, prices fell 50% or more.
So people were underwater.
Deeply underwater. Owing $400,000 on a house that was now worth $200,000, millions of families lost their homes.
And it wasn't just a U.S. crisis. You mentioned Iceland earlier.
Iceland is the most extreme example of what happens when a country's banking system grows to a monstrous size relative to its economy. Their banks were something like 10 times the size of their entire GDP.
10 times.
So when global credit froze, they couldn't fund themselves. The entire country went bankrupt overnight. Their currency collapsed. Their stock market fell over 90%. It was total, complete economic devastation.
And then, of course, it spread throughout Europe, triggering the sovereign debt crisis in Greece, Spain, Portugal.
It was the ultimate painful lesson in globalization. It showed us that we are all tied together now. A bad mortgage written in Nevada can bankrupt a town in Norway.
Let's talk about the recovery. Because I think for a lot of people, this is where the lasting anger comes from. The recovery wasn't shared equally.
Not at all. Not even close. The stock market bottomed out in March of 2009 and then went on one of the most historic bull runs in history.
So the wealthy, who own most of the stocks, they did great.
The wealthy recovered their lost wealth relatively quickly. But the middle class and the poor, whose primary source of wealth is tied up in the value of their home, it took a decade or even longer for housing prices to recover in many areas.
So it widened the wealth gap.
It widened the wealth gap dramatically. And it also widened the racial wealth gap. There's overwhelming evidence that a disproportionate amount of the most predatory subprime lending was targeted at minority communities. So when the crash came, Black and Hispanic households lost wealth at a much faster rate and recovered much, much slower than white households. The effects are still with us today.
So let's talk about the government response. We had TARP, but we also had the Fed going, as you said, all in.
The Fed cut interest rates to zero. But even that wasn't enough to unfreeze the system. So they embarked on a series of unprecedented programs called quantitative easing, or QE.
This is the part everyone calls printing money.
That's effectively what it is, yes. The Fed created trillions of dollars of new electronic money out of thin air to buy up government bonds and those toxic mortgage-backed securities from the banks.
And the goal was what?
The goal was to force long-term interest rates down across the entire economy and to push investors back into taking risks, back into buying stocks. It absolutely saved the banking system from collapse, but it also had the side effect of massively inflating asset prices, which again exacerbated inequality.
And on the legal front, the justice part of this, who went to jail?
This is the statistic that just makes people's blood boil, and for good reason. In the United States, for their role in the worst financial crisis since the Great Depression, only one single top banker, a guy named Kareem Sarageldin from Credit Suisse, went to prison.
One guy, out of an entire industry that was shown to have committed fraud on an industrial scale.
One guy. The Justice Department under President Obama made a strategic decision to focus on extracting huge fines from the banks rather than prosecuting individuals. And they did. Banks paid hundreds of billions in fines, Goldman, JP Morgan, Bank of America. But the individuals, the CEOs, they kept their bonuses, they kept their jobs.
And you contrast that with a country like Iceland.
It's a night and day difference. Iceland let their big banks fail, and they jailed 47 bankers and executives. They took a completely different approach to justice.
So as we wrap up this incredibly complex deep dive, we have to come back to the big question, why? The Financial Crisis Inquiry Commission, the official government report, their conclusion was that the crisis was avoidable.
That is the most damning verdict of all. This wasn't an earthquake or a hurricane. It wasn't an act of God. It was man-made.
So who do they blame?
They blame a widespread failure of regulators who were captured by the industry and who truly believed that markets could police themselves. They blame a catastrophic failure of corporate governance boards of directors who allowed executives to take insane risks in pursuit of short-term bonuses.
And it was a failure of the system itself, wasn't it? The incentives were just all wrong.
The incentives were completely perverse. If you pay a banker a huge bonus to take risks, and you implicitly tell him, hey, if you win, you get to keep the money and buy a Ferrari. If you lose, don't worry, the taxpayer will pay for the crash. What do you think he's going to do? He is going to crash the car every single time.
So the final question, have we fixed it? We got the Dodd-Frank Act in 2010. Banks are required to hold more capital now.
The banking system is definitely, without a doubt, safer and better capitalized than it was in 2008. They have more of a loss-absorbing capital buffer. We have annual stress tests now. Those things are real improvements.
But I can hear a but coming in your voice.
The but is a big one. It's what some economists call the paradox of deleveraging. In 2008, the problem was that the private sector households and companies had way too much debt. To solve that crisis, the government essentially took all that private debt onto its own public balance sheet. We solved the debt crisis with more debt. Global debt is significantly higher today than it was in 2008.
And by keeping interest rates at basically zero for a decade, did we just blow a bunch of new bubbles in other places? Yeah. In tech stocks, in crypto, in other assets?
That is the billion-dollar, or rather trillion-dollar question. That's the fear. We trained an entire generation of investors to believe that the Fed will always be there to save them, to backstop the market. We may have stabilized the system, but we may have also made it more fragile in new and unpredictable ways.
We just kicked the can down the road.
We kicked a very, very big can a long way down the road. The question we all have to ask is, what happens when we finally run out of road?
On that uplifting thought, it is truly a story of hubris, of greed, and of the fragile, interconnected complexity of our modern world.
It really is. It is the most important economic and historical lesson of our lifetimes. Because if we forget how this machine broke, we are absolutely doomed to break it all over again.
Thanks for going on this journey with us. This has been The Deep Dive. We'll see you next time.